You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Mike Swanson from WallStreetWindow.com. Welcome to the show, Mike.
Oh, great to talk with you. It's been a wild week so far, that's for sure.
Watching the mainstream media, I thought there were rivers of lava flowing down the street from all the panic.
Well, I gotta say, it's playing out a little bit worse or crazier than even I ever expected. I mean, both me and you have spoken all year about the possibility of the stock market going into a bear market, and in fact, I really started getting adamant about it in July and personally making bets to profit from a declining stock market and making recommendations to do that and so forth. That said, what's transpired over the past couple of days, I nowhere was expecting a drop to happen this quickly, this fast. But I think we can figure out what are the ramifications of that and what caused it. That could be useful for people.
A lot of people, of course, they point the finger at China. What about computerized trading?
Well, I think that's a very big part of it and a key to understanding why the market has fallen as quickly as it did and what's likely to actually happen going forward. One thing about the computerized trading is 90% of the volume in the stock market comes from that. And these computer programs, they don't hold overnight. They look for technical support and resistance levels to buy off of. They look at the correlations, meaning the relationships between stocks and the market and stocks to each other, to try to trade based on things they compute in that fashion, which is really beyond the capability of an individual person. But these are the things they kind of look for, and some of these things that hold stocks for just seconds, sometimes longer than that. But the key is the stocks that they do this with are all going to be, they're all high volume stocks, typically in the S&P 500, the NASDAQ, the Russell 2000. Now, what's interesting, or what happened Monday, is the market was already falling fairly sharply last week, Thursday and Friday. But Monday, the Dow gapped down 1,000 points right on the open, and which is a pretty shocking thing to witness. Now, I was talking on the phone with a friend of mine before the market opened up, and we made the comment to each other that, look, if I have a trading robot, I would just turn it off right now. Why would I risk trying to play that? I'm not looking to invest. I'm just a robot. Why would I buy it? It's below all the support levels. And that seems to be exactly what happened on the open on Monday. The market opened up, and there was very thin volume in many stocks. I witnessed very strange options activity, and the market kind of fell, and some of the stocks really crashed. Some stocks were down 20% on the open, in fact. But then within about 30 minutes, some buying came into the market, and I think it's pretty safe to assume that buying was probably short covering from people who bet against stocks by short selling them before and now are buying them. And short sellers bring buying into the market in serious climbs like this. And I think they may have been the saviors, actually, for now on Monday. Now, what then happened is after the market stabilized and started to go up, then some of the robots resumed their buying activity. So that's, I think, an explanation for what happened on Monday, and that's had a huge influence on the stock market because what's happened to the individual investor, and this is the typical person, most people, millions of people, no one expected what happened Monday, first of all, and then there's such a big drop suddenly over such a short period of time. If the stock market had fallen 14% over a couple of weeks, there would be people who would be selling out on the way down, and those people would be buying now, basically. Or they'd have money to buy, tomorrow with. Instead, by gapping down suddenly overnight at such a drop, instantly people had giant losses in their portfolios without much cash on hand to buy with. But most people have really none. What this means is that the average person, small investor, right now is essentially trapped in the stock market. They don't have money to buy with, and then at the same time, most people are scared. They sell, the market could bottom and go up without them, and everyone on TV is telling you this is just a correction. So people are basically trapped. And an indication of this is that today, as we're speaking, finally the market rallied. The Dow is up over 600 points, finally, after this week of misery. But what's troubling is that when I look at what went up today, only about 70% of the stocks actually were able to close up. And there's hundreds of stocks. There's 243 stocks on the New York Stock Exchange that made new 52-week lows. Only 2 made a 52-week high. Only 73% of the NASDAQ was up. 60% of the volume on the New York Stock Exchange was actually a sell order. Well, what this means, and it's very significant, is that today, even though the market went up, tremendously as far as points go, the rally was very narrow. The buying was only in a select number of stocks. If this was the start of a true bottom, that was going to lead to a giant rally that would last for months, or the bottom of a bear market, or even the end of a correction in a bull market, a significant correction, which is what would appear to people. But if that was the case, we would see much greater buying across the stock market, not just 70% of the NASDAQ and many stocks making new lows. What's going on is that the stocks that went up are the NASDAQ 100 stocks, the so-called momentum stocks that are inside of exchange-traded funds. These are the stocks, though, that the computer programs trade. So they did a lot of the buying today, and not all stocks, are in these things. And the stocks that aren't in these things didn't do too well. They lagged behind, and if this was a true bottom, everything would go up. So this is a big warning, I think. And I do think, hopefully, the market can go up a little more in this, maybe even hang in there for a couple of weeks. But all this suggests to me that this is just going to be a bounce, and when it's over, we're going to go lower again. This is a market that has very thin liquidity, and that's the bottom line of it. In fact, it reminds me back in 2000, I was trading internet stock, and the market topped out. I started shorting some of them, and the stocks I would short back then, most of them don't even exist anymore, but they had very thin liquidity, and what would happen is the market would have these bear market bounces and rallies. These stocks would barely even go up, and then when the market fell, they would just collapse. They'd be down like 5-10% and so forth. And so, to me, I'm afraid it's almost as if much of the stock market is going to act, or has been acting, like an internet stock without any liquidity in it.
We'll have more with Mike Swanson right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with Mike Swanson from WallStreetWindow.com. Mike, what is the action on the stock market going to do to the possibility of interest rates going up this fall?
I'm sorry to laugh because it's a key question. I'm laughing because everything's becoming so crazy. The thing is about the interest rates is so far this year, the story has been that the U.S. economy is on a path to recovery. In the past, since 2008, interest rates have been zero. The Federal Reserve is engaged in multiple money printing operations. And this is, we all know the economy has sucked, and the recession of 2008 was horrible, and it was a crisis and so forth, and this is what the Federal Reserve has done. Now, the story that we've been told this year is the economy is about to grow and we're going to return to a more normal environment. Therefore, the Federal Reserve will be able to stop some of these emergency measures. They're going to be able to raise interest rate and have a normal Fed policy. Now, the problem is that with the stock market drop right here, all the talk had been that they would raise rates in September, and now that's basically off the table. Today, in fact, part of the reason the stock market went up is one of the Federal Reserve people, William Dudley, basically said the September hike is off of the table. And over the past couple of days on CNBC, I was watching Cramer and Jim Cramer and a couple other people claim that part of the reason the stock market's dropping is because the Fed wants to raise rates. Now the Fed's only been talking about raising rates by 75 points or a full point. It's doing it very slowly over a year, year and a half. Now, if the mere threat of doing that, which is, what is a 1% interest rate? If it's just the mere threat of a 1% interest rate is enough to crash the stock market, that suggests that all these policies that we've seen from the Fed and the government have been a total failure and have led us to a dangerous trapped situation, which I think is what we're actually in. And I think the real trap is the interest rates are zero. The stock market drops. The Fed won't be able to lower interest rates. So there's nothing the Fed can do. And then if Cramer and these people are right, the Fed can't raise rates without smashing the stock market. Therefore, we're actually perhaps in the worst situation when it comes to the stock market in our entire lifetimes. And I think that could be, I'll put it to you this way, the stock market has done things this week, falling this sharply in this amount of time off of a high that none of us have ever seen before. None of us have seen the Dow gap down 1,000 points and then the liquidity vanish out of the stock market because the trading robots were turned off. None of us have seen this. And on TV, they talk like this is just a correction and this is just temporary and everything's fine. But no one will admit, we never lived through, we never seen a market trade like this. And that's not good. I don't see anyone can argue this is a normal stock market. And the bottom line is what people need to do. I don't care how you're positioned now. People have got to be very careful. This is not the time to be jumping in and buying stock if based on the idea that this is just another one of these corrections we've seen the past couple of years, because this correction or this drop we've seen is nothing like those previous drops. In fact, it's even worse than the start of the last two bear markets. I've been in the stock market since 1999, and this is the worst action in a week I've ever seen. The stock market action is just as bad or worse than anything that happened even during the 2008 stock market crash. And that's not to say the banks are going under or there's some immediate problem in the economy. I actually don't think there is. But stock market action is very alarming. And first of all, I said people shouldn't be buying, but the reality is, as I said earlier, almost everyone listening doesn't have any money to buy because they're already invested. Well, what people need to really consider is the stock market's likely to bounce. We were up heavy today. It's likely to hold in there a couple weeks. If the people that are bullish of the market are right, it'll trade sideways. They're going to compare this to 2011, 2010, when there was a flash crash in 2010, and the market went sideways 6 to 8 weeks and then broke out to the upside. That's what they're all going to compare this to. But the market is trading a little bit differently than it did then. And if I'm right, it's going to go lower by the end of September and just continue to drop, and it's just going to be a disaster. Well, someone listening that's fully invested, they may just want to ignore that, but I suggest what they should do is just watch the stock market. If it bounces or holds in there for a couple weeks and then goes lower than today's low of about 1867 on the S&P 500. If you just think about that, 1867. Last Monday, the S&P 500 was above 2100. That's how fast it dropped. And if it falls again below 1867 and at the end of September, October, people have got to seriously get out, raise money, raise cash, do some selling, because this is just going to get even worse. Now, ultimately, I do think gold will go up and benefit from all this mess, even though right now it's basically going sideways. Gold has fallen since 2011 and put in a low, and it rallied up above near 1170, now it's like 1120, going sideways. It's actually outperforming the stock market since the Nasdaq peaked out in July, and even the mining stocks are outperforming, even though they're down today. But ultimately, I think they'll benefit and go up. So people, I've suggested this before, I'll suggest it again, they should own a 10% position in gold, because if the stock market does break down again this year, go through the lows here, people won't. First of all, people are not going to be talking about the Fed raising rates on television anymore. They'll be talking about Fed begging for another quantitative easing program, and it's just going to be a disaster. But gold would benefit ultimately from that. What we're really facing is going to be the erosion of a belief system that's really fueled the stock market higher for the past couple of years. And that belief system can be summed up in a couple phrases, which everyone bullish on the stock market has believed, because they tell me this. And you hear it on television all these times. The belief system is simple. Valuations do not matter. That's the number one principle of a stock market bull. They say that because just a year ago or 2 years ago, the stock market reached a valuation level not seen but twice in its history, 1929, 1987. You use the cyclically adjusted P ratio, look that up on the internet. People listening, they can see that. The stock market, that valuations don't matter. That number doesn't matter because the Federal Reserve has interest rates at zero. Therefore, stocks should be worth more than they ever have before because they pay a dividend. Second principle they believe is that the Federal Reserve will never allow the stock market to drop again. They'll step in and do something. Well, the first principle, we're seeing the results of that belief system. Valuations do ultimately matter when it comes to the stock market. The best times to invest are when the stock market is at a cheap valuation. Well, that's just common sense. The high valuations don't matter until they matter. Now they matter. Second principle, that the Fed will bail you out, make the stock market go up. It's going to turn into be one of the most destructive belief systems our country has ever been prey victim to, because the fallout is going to really harm the economy. But that's down the road. As far as people's accounts and investments go, the problem with the belief system for them is that it's going to fail. The Fed can't cut rate, and they can't really start another money printing program at the turn of a dime without actually creating more panic in the stock market. And even if they do create another money program, there's no guarantee it's going to work. China has created one over the past couple of weeks, and it's not stopped its stock market from dropping. The European market's created one back in February. They launched one, and ever since then their stock market's dropped, and so has their bond market. So the Fed policies are going to fail, and the Fed can't make the market go up anymore. So it's the erosion of the entire belief system that underpinned the whole bull market, and in the end, a whole new belief system will replace it as the bear market continues. It hasn't even really started. Right now, most people just think this is a correction and they have nothing to worry about and they're going to believe in it. Very few people are going to sell or get out. They're trapped. They feel trapped. They feel uncomfortable. There's no doubt about that. This has not been a fun week for anybody, but, let the market bounce like it did today. Let it hold up a couple weeks, and people will just kind of forget what they've experienced this week and believe in those two principles I've spoke about again, and it'll take much lower stock prices for people's belief system to get shaken out. It's become like a religion for people, but unlike the Bible or Christianity or, I'll talk, other religions too, let's say, all of them probably have some basis of real reality in them, some form or another. This one, in the end, won't, and it's going to be tough.
Mike, thank you very much for chatting with us.
Yeah, thank you. Next time, I'll try to be more cheerful.
My guest has been Mike Swanson from WallStreetWindow.com. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. Our YouTube channel is Talk Digital Network. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.